My sense is multifamily is down between 15 and 25% from the peak, which I would designate as January 2022. We're going to see a much higher volume of properties actually transact at the lower price levels. The seller's asking 10 million and we're offering 8.5, and it's just no deal, nothing happens. I think next year you're going to actually start seeing the deals happen at the 8.5. And then everyone will say, oh, look, prices are down another 10%. No.
Let's start with that. So how did you win the favor of said elders? DAPT, for those that don't know, DAPT, David, Andrew, Pat, Tim. How did you get to be the A in that lovely little acronym?
Starting in like 2008 was Tim Rode. And so, he was a mentor in business, we started skiing together, became friends. And then when I transitioned into multifamily, the very first one I did, he brought Pat and David in as investors. I remember we were on a family vacation and I was sitting at a hotel room in Illinois on a conference call, and Tim introduced me to those two guys. And so they invested in that deal, and then they all invested in like the next two. And then we were at a conference. This was before Gobundance had started, and they were right about the same time. And they pulled me aside and said, "Hey, look, we love being actual investors, but we know a lot of wealthy people, and you're good at operations. So how about we partner, and We'll help bring in equity and investors, and you can focus more on operations." And I'm like, hey, that sounds like a good partnership. And, especially I had only fairly recently gotten to know Pat and David, but I knew how amazing of a guy Tim was. And, knowing that these are his, two of his best friends and the guys that he respects, I'm like, this is probably a good thing. And it's been amazing it's really been an awesome thing, not just in building a business, but just getting to interact and hang out with and learn from those three guys for so long has been a huge impact and blessing on my life. So,
can you talk about, maybe this is advice for anybody listening, on soliciting partners like that? Not even soliciting, that's not the right word. The story you just told was organic. Tim, you're doing some stuff. People could bring money in, but there's something that you were doing or not doing, or there's something about you that obviously attracted these folks who are, very well-known investors in our world to say, yeah, we want to be partners with him. Do you have any sense, if you were advising somebody on, hey, I want to be a partner with, maybe it's not the elders, but some other big name that they've heard of in GoBundance, or some other big name in the real estate space, you for that matter, what is the kind of value that somebody needs to offer, or what are some of the things that you did well, intentionally or not, that won the favor or won over the ability for you to long-term partner with rock stars?
Yeah, it's one of those things. It's kind of like who was it? What was it? The Supreme Court justice said, when asked what's the difference between pornography and art, and he's like, I don't know, I just know it when I see it. It's kind of one of those things, like you just know it when you see it. I think what it comes down to is, it's not like, okay, go do these three things, and then all of a sudden you can have the right partners. It was a matter of, I think that they could see that as an operator and as a person, I almost hate the word authentic nowadays because it's just so overused, but doing things as correctly as I knew how to do them, as being fully transparent, trying to put everyone's interest, really our investors' interest first and mine second. And it wasn't because I had a perfect track record. I mean, I hadn't lost any money or anything, but it's not like everything I had touched had been a home run. So I think it was a combination of just alignment of values, and seeing a mutual opportunity. It might actually even be a better question for them. But what did you see in this guy? And who knows? Like I said, Tim was the one who originally brought them into my world, and vouched for me. And anyone who knows Tim is, that guy's he's got a heart of gold. And I can tell you one thing that kind of led to it is I, especially if it's somebody that Tim brought into my world, I just had a sense of I never want to let Tim down. right? So I'm going to deliver as best as I can for these guys. And I think that just, if you're consistently, honestly doing that, people will see that and take note. And that's generally, something that people want to be a part of or be around or partner up with. So
Do you ever anticipate a world in which you're not partnered in any way? And even with these guys, are you at a point, or do you envision getting to a point where you say, hey, for all of us, it's time for me to move on my own?
I don't. And actually, the biggest mistake I made was just doing it alone for too long, for as long as I did. You know, the number one, yes, I could go out and do sizable deals completely on my own. It wouldn't be as fun. It wouldn't be as good for our investors because we would lose the depth of knowledge and insight and resources that my partners contribute. There's other financial and business aspects that contribute, and candidly, I hear about all these people, partnerships breaking up, and you hear it. Partnerships like marriages, right? Easy to get into, much harder to get out of. And I've been fortunate that we formed DAPT 10 plus years ago, and it's been great the entire time. I generally enjoy being partners with the three of them, and I've really come to love having a team and of rock stars. So separating from that would be the last thing I would even consider. Even if somehow I thought the financial gain personally would be greater, I think the intangible value of the partnership is larger. And candidly, life's too short to be doing things you don't like or that aren't fun, and it's fun working with those guys. So.
It's funny. I'm on the flip side of, I feel like in some ways, a partnership with them, not at the scale that you're at, but with Emerge, with Gobundance Emerge. That's an entity separated out that I am, one of the 5 elders of, if you will, right? So you got the 4 elders and then me kind of as a partnership in Emerge. And it's sort of the flip. You were, hey, let me run this thing from behind the scenes, so to speak, right? And you bring in the capital, great. And my thing is more like, hey, I want to get the biggest microphone I can possibly find. And these guys are like, well, we don't want that. So here you go. Build your brand off of Gobundance. Here's the podcast. Here's Emerge. Be a partner with them. And I'll be honest, I have thought about, is there a point at which I need to move on from? And, what it always boils down to is, one, why? Because these guys are great, and to your point, there's so much more equity value in being in their world. And they honestly, they're not involved. They don't bother me. They don't, they're not all over me. They just want to know that things are going well. How can we help, this, that, and the other? But there's a lot of value in the ancillary connection, ancillary benefits, if you will, of being partners with them above and beyond. And yeah, I couldn't have chosen or couldn't have been blessed with a greater group of guys, to be honest with you, to be partners with. So what's up, Tribe listeners? I want to talk about our sponsor for today's episode, Gobundance, the tribe for healthy, wealthy, generous people who choose to live epic lives. It's a tribe I've been a part of for 5 years now, and I keep coming back year after year because of the quality of the connections and interactions that I get and the accountability that I get toward the goals that I'm looking to achieve. Gobundance has meant everything to me. So I'm really, really proud to sit here on the Tribe of Millionaires podcast and tell you a little bit about Gobundance. Here's the thing. Why do you live where you live? Think about it. Why do you live in the neighborhood you live in, or the apartment building you live in, or wherever it might be? Usually people move into a community because of the quality of the neighbors and all of the amenities that are available to them. And then they go about using those amenities and leveraging that community to the best of their ability for growth. They make connections with neighbors, lifelong friendships, things that serve them. We want that for ourselves, for our wives or husbands, and our children. That's what Gobundance is at the next level. Imagine if you're a man moving into a community of other millionaire men that are driven toward being the best versions of themselves as fathers, as husbands, in their health, in their relationships, in their contribution, you name it. That's what Gobundance provides. For me, it's been everything. I get with my Gobundance brothers on a weekly basis and I tell them, this is where I'm trying to go. Things I can't share with the regular folks in my life, my friends, my family that I've known forever. They only know me for who I've been. GoBundance guys, they know me only for who I'm becoming. And when I deviate, when I go off course from being that guy, from taking action toward being that guy, that's when they step in, that's when they hold me accountable, and that's what accelerates my growth. Go to Gobundance.com right now and apply. If you're a millionaire and a man, Gobundance.com. If you're a woman and a millionaire, GobundanceWomen.com. And if you're not quite a millionaire, go to GobundanceEmerge.com and you join me in the community that I've created in partnership with Gobundance to get yourself to that place of being what we call a whole life millionaire. Gobundance.com. You can start there, see everything that we have to offer. It's an incredible community. I can't wait for you to be a part of it. Now, back to the show. Your first deal, I've heard this legendarily. Your first deal, I don't know if it was with them or not with them, but it didn't go so well. Can you give a little bit of context? Again, was it with DAPT or not? Or maybe it wasn't called DAPT yet. I don't know. And what was the reality on the ground of that deal?
Yeah, my first one, was done under my personal entity, Vantage Point Acquisitions, which is the manager of DAPT. So it still exists. And a lot of people will be like, wait, I hear Vantage Point, I hear DAPT. What's the relationship? But functionally, they're basically the same these days. But so my very first deal was a mostly vacant 1960s and 70s 92 unit property on the other side of the country in Macon, Georgia. And low income area, higher crime area. I remember we walked into the police chief's office and said, "Hey," introduced ourselves, said, "Hey, we'd like to work with you and help clean this area." He just looked at us and said, "Good luck." And we're like, that's not quite the response we were looking for, but all right. Anyway, we did get it cleaned up. And, it's funny. That definitely was a learning experience in terms of, we underestimated the renovation budget. We had dealt with stuff like vandalism that cost $50,000. You don't typically have that in your CapEx plan. It was a challenging property, but it was, I would, in the grand scheme of things, successful for, I would say, two big reasons. Number one, we did end up selling it for almost 3 times what we bought it for. So it did end up a profitable deal. And then second, I probably wouldn't be talking to you if I hadn't done it. At some point there's you can analyze so much, but at some point you gotta take the leap and do a deal. And some people ask me, well, how did you get that deal? Well, I think the broker saw a sucker a mile away, right, and said, I can get this guy to buy this thing. And it was just through, grit and relentless persistence that we pulled it out and made it successful. But again, I just learned so much by doing that. And like the stuff we do today, is informed and shaped by those early experiences. Like, okay, this is what we don't want to do. So, going forward, here's what we're going to do differently. It actually, so it was it's part of why my hair is as great as it is now. But in the big picture, it was, it led us to here. So it was good.
You look California cool to me. And I always say that it's like parenting. You can study it only so much, but at some point you got to have the kid to really experience it. It's the same thing with real estate, right? Like you can study. Go ahead. I'm sorry.
And the first kid does not necessarily prepare you for the second one, because even though you mix the same 2 ingredients, they come out completely different.
Well, crazy. They come out completely crazy, the second one. That's been most people's experience, at least. But it's the same with real estate, right? There's only so many Bigger Pockets episode that can get you prepared for the $250,000 CapEx, or I've had 2 sewer pipes go because I just didn't learn the first time to do the due diligence to that level. So it is what it is. If I'm not mistaken, and tell me if I'm wrong, your deals are structured as 506B, meaning Correct. For non-accredited investors, which means you can't advertise or anything like that. I'm just thinking, what is the advantage for you with a 506B versus a C?
So yeah, you're right. 506B means you can now 85% of our investors still are accredited.
I was going to ask that.
But what 506B means is we can take sophisticated or non-accredited investors, but we're not allowed to advertise or solicit in any way, which means the only people we can take into the deal are people that we already have an existing relationship with. 506C is when you can advertise all over the place. You can do Facebook ads, whatever you want to do, but you can't take those non-accredited or sophisticated investors. The reason we've stuck with 506B is there's a handful of them. Is number one, our investor base has grown big enough organically and through referrals that we've never needed to advertise or solicit. Every deal we've done has sold out, in some cases very quickly. Even this past March, which was a very different environment than has been the last 10 years. Also, some of those sophisticated investors have been with us a very long time, and we feel a bit of loyalty to them. We don't want to be like, oh, hey, we're big now. Sorry, you can no longer invest. It's kind of a combination of those two things. We haven't needed to. And then also, once you start soliciting, there's additional paperwork and hoops you got to go through. So now, with all that said, that doesn't mean we never will do a 506C. Which allows us to solicit. But even if we do, I would envision that we would still occasionally do the 506B so that the folks that have been with us for a long time can still participate.
So with Quantum, we've always done B. I've been pushing C just because I'm an out in front guy, right? I want to test my ability to market, for additional investors, and we're not at the size of what you built with Dept. But one of the things that we always come back to is the burden of proof, if you will, for accreditation between the two. You said paperwork is one of those things, right? Yes, filing. But if you're a C, we own as the company, we own confirming your accreditation. Whereas if you're a B, right, they check the box on the
I can take your word on it. Yep.
Right. I could take your word on it. But there is the B to C conversion option now. Have you considered that? You can be a B for a period and then flip to a C.
Yeah, and that is very intriguing since they started allowing that, and that is definitely something I could see us doing, especially as we get into next year, and I anticipate the flow of really good opportunities to pick up significantly. I could see doing that, starting off as a B and then maybe going to a C. And even then, I don't know if we'll necessarily like all of a sudden start doing Facebook ads or something. What it'll mean is I can just talk about it freely, right? Yeah. So like if I'm at a conference, at a panel, or on a podcast, I can't mention that or even mention that we're doing a deal. But if we're doing a 506C, I don't have to worry about that. I can say, oh yeah, we're in the middle of buying this deal in Atlanta or whatever. So yeah, I could see that's Jamie. That's a really good point. My guess is I shouldn't say if, the probability of our first 506C will probably be a conversion, which let's just get the sophisticated people in first, and then say, okay, time's up. We're converting to 506C. And anyone else has to now come in under those rules.
Some additional cost, but might be very well worth it. So let's talk about that. I don't want to say the word notorious, but I will. Notoriously conservative, meaning when a deal, and this is part of your brand, whether you know it or not, I'm sure you do, that when Andrew Cushman publishes a deal, it's, boy, has it been beat up. Has it been vetted? Has it been, looked at in every possible doomsday scenario? Maybe a lot informed by that Macon, Georgia deal. I don't know.
Mm-hmm. Yeah.
But in this market, we're recording August 2023. In this market, if you're anything like we are right now, there's nothing. There's just nothing that we see that pencils out. What are you doing in this? Are you still looking at a ton of deals? Are you seeing anything turn? I guess brief state of the market from your perspective. And to be clear, you're looking at A-class multifamily property, correct? Is that a fair A-B?
B minus to A minus.
A minus to B minus. Okay. So you're looking in that space, larger deals, multi-million-dollar deals. What are you seeing right now? What are you looking at? What's kind of coming across your desk? What do you feel in the moment? And then we'll talk about what you see in next year, which you started to talk about a little bit.
Yeah. As much as we would like to be buying, we're not buying either. We do a quarterly analysis of everything we've looked at. And out of the last 200 and some odd deals that we looked at in the most recent quarter, at the average gap between the asking price and what we're offering is 15%. So, if the seller says my number is 10 million, we're probably at 8.5. We might be at 7.5 or 8, but what that means is, so, we closed our last deal March 30th and haven't gotten close since then. And even that deal was a needle in a haystack. where we had looked at several hundred and it just checked every box perfectly. And it was a loan assumption.
Yeah.
So we were at 55% LTV at a 4.2% fixed rate. And the seller was pretty motivated to get out for some other reasons, and it worked. I haven't been able to find anything since. And so I think what so the properties that have traded, you'll see in the headlines, oh, multifamily's down, I saw 13% the other day or 10% or whatever. My sense is the numbers are real numbers. Our multifamily is down between 15 and 25%, depending on market and asset class, from the peak, which I would designate as January 2022. Looking forward, my sense is that as long as interest rates, so as when we're talking today, the yield on the 10-year Treasury is roughly 4.2. And as long as that yield, which is what most fixed rate, commercial mortgages are based on, but we'll just say interest rates in general, as long as interest rates in general don't move significantly higher than they are today, I think we've probably seen we're either at or close to the bottom for multifamily in terms of pricing, but not in terms of volume of transactions. So what's happened is most sellers or owners have been the operations are still really good. Mm-hmm. That's one. It's the distress is purely on the debt side. And now we're starting to see a little bit of some signs of softening, but nothing major. So most good owner operators are not in a bad spot unless they put the floating rate debt on their properties. And so a lot of owners are testing the water saying, well, all right, I'll look at some offers. And they're like, I'm not going to take that. And they're saying, I'm not going to sell. So transaction volume right now is 1/4 of normal. Yeah. And what we're seeing in talking to the brokers are telling us, hey, we're doing way more BOVs than we were a couple of months ago, which means people are saying, oh, geez, I actually am going to have to start selling here pretty soon. So I think what we're going to see is, we're going to see a much higher volume of properties actually transact at the lower price levels. So where the seller's asking 10 million and we're offering 8.5 and it's just no deal, nothing happens. I think next year you're going to actually start seeing the deals happen at the 8.5. And then what that's going to translate to is you're going to have more comps at that number. And everyone will say, oh, look, prices are down another 10%. No, they're already there. It's just no one's really transacting. And now if rates go up another 100 basis points, that changes the calculus. But that's my sense is that, let's say in your market, multifamily is off 20%. That's probably going to be the majority of the decline. And it's just properties need to actually start transacting there. Of course, the two wild cards are, do interest rates go way higher? That shifts it. Or do we get into a serious recession with major job losses that decreases NOI, net operating income? That could affect it. But we try not to. You mentioned us being notorious for being conservative. One of the things we do that I think has led to that is we don't underwrite to an outcome. We underwrite to a bell curve of probabilities. And what my bell curve looks like is the highest probability is what I just outlined. But there's what I would call a left tail risk of, what happens if interest rates go 100 basis points higher? That changes things. So what does our exit look like if that happens? Interest rates could go down 200 points. What does it look like then, right? That's a right tail risk, which is basically a good risk.
Anything that you've underwritten in the last 3-4 years, 2-3 years, 2 years for that matter, is anything on that bell curve touching where interest rates are today? Like, in other words, is even this economy, because that's so I'm in a couple of deals where, of course, the operator, and you said it really well, the operations are strong, but their debt is where they're getting in trouble. So I'm in a deal in particular with a specific operator, not a Gobundance member, that and they've been very communicative. They've been awesome about it. But their point is, like, it went up way faster than we could have anticipated. To me, that says they didn't either have the right rate cap in place, or they just didn't, they didn't underwrite to a very conservative exit rate, if you will. But is where we are today within the realm of your bell curve, or has it risen beyond even where your bell curve would be in this timeline?
Well, so the where we are today is a point on the far left tail of the bell curve.
It's on there though.
Yeah, but meaning none of us thought rates were going to go this high this fast. When we were buying in 2022, the forward-looking rate curve basically the market was saying rates are going to go up a half a point over the next 2 years. We would underwrite to 100 basis points, but then we would hedge in case it was worse than that. So what that looked like in terms of, okay, well, that's great, Andrew. How do you underwrite to a bell curve of probabilities? The base case was, well, rates are going to go up 100 points, but what if they go up a couple hundred or more? And so what we did is we looked at it and said, all right, how do you hedge against that? Because that's the biggest thing that could blow these deals up. We said, all right, statistically speaking, rates today are at historic lows, like all-time historic lows. So if you look at the statistics, if you're making bets in Vegas, the odds of rates being higher in the future were much greater than rates being lower in the future. So we said, you know what, let's just fix these. Like the downside of fixing them is far less than the potential downside of floating them. So we fixed everything except for one, and I'll get to that one in a second. So we have properties that we bought in late 21 and a couple of them in 2022 that we fixed the rates. And today those properties are, the debt coverage ratio on our portfolio averages 2.2, which means we can pay our mortgages 2.5 times over almost, or 2.25 times.
2.25. Yep.
And so that's how we hedged. We didn't think that was going to happen, but we hedged just in case, right? So we fixed, and those properties are all doing great. There was one property that we bought in October of 21 where there was a new construction element to it because there had been a large fire, and we had to get floating rate. We had to get a bridge loan. And that was one where we said, okay, 2 years down the road, we should be done with the repositioning. We're going to refinance at that point. And we plan, the rate curve says rates are going to be a half point higher. Let's plan on a full point higher and we'll get out. Okay, what if they're not? Well, how can we mitigate it? Well, let's make sure that we have a guaranteed term of at least 3 years instead of 2. So we had to argue for a 3-year loan. We got it.
Yeah.
So, all right. At what point, if rates go through the roof, does this property go negative cash flow? Okay, let's make sure we have a rate cap that's below that point. So we bought a 3-year rate cap for $46,000. That rate cap now pays us $40,000 a month, right? So that insurance policy, and that's, and we're not heroes for buying a rate cap. I mean, any smart lender would make you do it anyway. So that's how we at least hedge the worst case scenario. So that is the only property where we have an area of concern, because that the rate on that loan has gone up so much. So it's not something that we want to keep. That loan has it comes due at the end of October of next year, 2024. So we have some time on it. The property's doing well. We just got it valued, and the value came in several million above what we purchased it for. And because of that rate cap, it still cash flows. However, when it comes time to exit that loan in next October, we will probably be looking at somewhat of a cash in refinance, or like another option is to just sell the property. It's a really good property in a really good area, so we'll probably do the cash in refinance. And I know a lot of people are seeing capital calls and stuff lately. There's two kinds, right? There's a capital call that says, "Hey, we don't have enough money to pay the bills." That kind of capital call could be throwing good money after bad. What we would be doing is just saying, "Hey, you know what? We need to refinance this loan and put a little more equity into the deal." Right. So it's basically, we bought it at 65% LTV. It'd be the equivalent as if we had bought it at 55 instead. Right. So we got to raise $2 million so that we can, cover the expenses for the next year. we'd be looking at, well, we might need to put in $1 million or $2 million or whatever to buy down some equity, but then it still remains a solid property. Will it hit the pro forma? Probably not if we have to do that, but it'll still should be profitable. So that's the only one that right now the outcome is not what we desired, but thankfully we did have it set up so that we're not getting killed by that left tail risk.
Do you anticipate or project rates coming down in the next 12 months, and why? What would be the variable that would pull them down?
You know what? I could sit here and give you a great argument as to why they're going to be 200 basis points lower at the end of 24. And then I could immediately turn around and give you a great argument for why they're probably going to be higher at the end of 2024. So, which is again, why we underrate the probabilities, because I'll listen to a podcast and the guys are arguing, telling us all the reasons why they're going to be lower. I'm like, dang, yeah, they're right. And then the next podcast I listen to is like, hey, guys, this is why interest rates can be high for the next 10 years. I'm like, oh, crap, they're right. So, my sense is, again, just operating in terms of probabilities. If you look at the history of the federal funds rate since 1954, there's roughly 12 or 13 rate cycles there, depending on how you define a cycle. And like 12 of the 13, every time rates, once they pause, on average, 9 months later, rates come down faster than they went up, right? So if you go to this, so go to, if anyone who's like, what, really? Go to the St. Louis Federal Reserve Board's website, and that chart is on there. You can pull it up and look at it for yourself. That his 12 out of the last 13 cycles, rates come down faster than they've gone up. So who am I to argue with history, right? You can just say, well, this and that, and this time's different, and this time is different. Every time's different. But the last 70 years, that's what's happened, because the Fed almost always overshoots, puts us into a recession. You can't have a big recession, especially in an election year next November. So they cut rates really fast to try to bail everything out. Will that actually happen? I don't know. I'm not going to bet on it. It's definitely a non-zero chance of that happening. But there's also indications that inflation is sticky, and the Fed might cut a quarter of a point in the second quarter of 2024. But is that going to be meaningful to a real estate operator? Like, no. That's just going to put us back to where we were 2 months ago. So the idea, again, at the end of the day, I have no idea. I just try to listen to all the data points and informed people that I can, map out the probabilities and say, all right, here's the base case, and let's make sure we don't get killed if that one, it's not what happens.
That's amazing. Did you know that I think it's the St. Louis Fed, former head of the St. Louis Fed is a GoBro?
I did not know that. No.
I think it's is there a Kansas City Fed?
Yeah, there's a KC Fed.
Might have been KC. It was in Missouri. That's all I can guarantee. But one of those two are former head of that Fed is a Gobundance champion. I can connect you if you'd like. But yeah, why not, right? Well, that's fascinating. That's really interesting. Okay, so you're gearing up for the. Just to recap this a bit, you're gearing up for the prices that are today that just haven't been realized in transactions until next year. You're anticipating next year that's when all of this goes down. For somebody buying next year, I don't know. Like I've been on this pulpit, and I lucked into being with an operator that's conservative in how we buy, and it's always low loan to value, fixed rate debt, right? All the stuff we buy is low loan to value, fixed rate debt. And to your point, last 3 deals were creatively financed. An assumption, a 1031, a large 1031, essentially a JV, kind of like one LP essentially, and then the GP invested the remainder. And an owner finance deal was the last one we did in May at like 2% for 3 years, I think it was. So pretty good debt, right? But very low loan to value, a lot of equity raised, so on and so forth. Is that the way? Is that what we learned from this cycle? That look, these operators that went from 0 to 800 million in assets under management in 3 years, they're doing it all with variable bridge type debt, and fixed rate low loan to value debt is the way to go. Is that what people need to do in the next year if they're starting to ramp up their multifamily?
It's funny. Yeah, you touched on it's a lot of the problems lie with Yeah, the groups that started just 3 years ago and went from 0 to 800 million by, winning the bid every time and doing it with highly leveraged, floating rate debt. Sometimes they would stack, mezz debt or preferred equity on top of that, right? Which is just another form of leverage. So if you're an LP behind that, forget it. Going forward, it's not actually so simple to just say, okay, well, I'm just going to fix all the time, because it has to match your business plan. If you put a 10-year, Fannie Mae loan on a property and fix it at today's rate, but you plan on selling in 3 years, that prepayment penalty might end up being 20 or 30% of your loan balance. Right. So fixing is not without its downsides too. So you have to match the debt with your business plan. We typically look to hold 5+ years, so it makes that decision a little bit easier. I'm going to throw something out there. I'm not necessarily saying everyone go do this. And it definitely would go against the emotional current of the day. But again, if look at this statistically and from just a mathematical, cold, hard facts way of looking at it, is it better to float your rate at the bottom of a rate cycle or at the top of a rate cycle? Well, everyone who floated at the bottom of the cycle is now getting killed.
Good point. Yeah.
But now that seem like we're at the top, even though it goes against everything your emotions and your gut tells you to do, because you're seeing everyone get burned, when you're at the top of the cycle is when you float. And then you ideally ride it down. When you say, okay, Andrew, you talked about hedging against left tail risk. Well, how do you hedge against it if you're floating? Well, you can buy what's called an in the money rate cap. So let's say you're, all in floating rate. And I don't do floating. I haven't done a floating rate loan in 6 months. So these rates could be completely off the wall. I'm just pulling them out of the air. So, but let's just say you do a floating rate loan that's at, 5% right now. And you're hoping that it floats down over the next 5 years, but you're like, hey, if this rate gets above 6%, I'm hosed, or I can't afford it. So, or even 5%, you can buy a rate cap that effectively locks your rate at 5%. Because if it keeps going higher, that rate cap will pay you the difference. It's like trading options in the stock market. Now, is that rate cap cheap? Absolutely not. So, there's just a lot of costs and things to factor in. It's not so simple as, I'm just going to fix right now. Now, if I was going to buy something and I knew I was going to hold it for 10 years, I might go ahead and fix. Just say, you know what, it works well today. I want to just completely eliminate that risk. It's okay if rates go down and, I don't want to refinance. I'm going to hold this for 10 years anyway. But if I hope to exit in 3 or 5 years, it's a shorter timeline, that's when there's a few other factors to consider.
That's a great point. I hadn't thought of that, because I don't, you study this way more than me, but I think that, I think rates either stay up or go down in the next 12 to 24 months. I don't see them going like way high. I think they go up a quarter point maybe. Although the last I saw, there's, I think, a 90% chance based on whoever the economists are that do this, that say the Fed will pause rates in the September meeting. Who knows? I mean, that's what economists say. And if they do, maybe they've hit their last raise. I don't know. Maybe they've done their last quarter point raise and they're going to leave it static for a while through Q4. I think there's probably one more quarter point raise in them. It's just me. Maybe it's gut feeling or whatever, but I don't know. That's an interesting point, because I think if I were betting, if I were putting some money down, I would say rates pause or go down. So that's a really interesting point based on hold time. Hadn't thought of that. Smart man. Notoriously conservative. Let's dive into these. Let's dive into these Gobundance member questions, so we could get you out of here on time. So first, we have 6 pillars in Gobundance. I usually write them down. I'm going to do them by memory. Horizontal income, a bucket list adventure, authentic relationships, genuine contribution, extreme accountability, and I think authentic relationships or age-defying health is the one I didn't say. Whichever of those 6.
Age-defying health. You got
That's the one I didn't say. In which one of those pillars are you crushing it right now?
Again, this is one of the benefits of being partners with the elders for a decade is they've really helped me on a lot of these. But oh man, that's tough to pick. Can I pick 2?
Yes.
All right.
Do whatever you want.
I'm going to say the one, horizontal income, because I don't call it passive because it still requires some guidance and management, but our portfolio produces more than enough to pay all of our team members, salaries, my personal expenses. And that's part of why we can sit here and like, all right, if we don't do a deal till next year, that's fine, no problem. So I feel, very fortunate to be in that position of having the horizontal income that we can be patient. And then bucket list adventure. The reason I just feel like I can't leave that one off is because this past winter, my friend and I went down to Antarctica, and we climbed and skied like 8 different peaks on the Antarctic Peninsula after we stopped in Argentina and warmed up there. So that was a heck of an adventure and just absolutely amazing. So.
Very cool. Wow, I hit that continent. Most don't. So that's amazing. And which of those pillars could you use a little bit more support or accountability?
Probably authentic relationships. And the reason I picked that is the relationships that I have are phenomenal. I've been married 18 years. Our marriage is better than it's ever been. I've got a great relationship with my entire family of origin, meaning my parents and siblings. I've had the same best friend, guy friend, for 20 something years. However, I don't do a good job at creating new relationships, or kind of expanding. I have a tendency to be, I don't know, not fully introverted, but what's the word? Oh yeah. So I'm not antisocial. I'm not social. I'm just asocial. Like I just kind of I just have a tendency to just do my thing. And if someone like connects with me or reaches out, okay, fine. But I don't put the effort into forming more, high quality, authentic relationships. And that's something I should do.
Well, like I said, I'll get you one new connection today. So I'll take care of that in some respect. There's your support. Where in any area of your life are you potentially flirting with disaster?
Yeah, that's a good one. By my nature, I don't do that. I mean, I guess every time I go into the backcountry, there's avalanche risk. So I mean, I literally am flirting with the disaster in that case. Again, we're trying to do everything we can to mitigate that. I would say probably the biggest, there's 2 other things that come to mind. Is one, just the idea of asset protection. I live in a very litigious state, and while I think we're pretty well set up, there's some things I'd like to do to improve that. And then really, it's probably I'm flirting with disaster and something I don't know about. There's, where's the gap in my knowledge that I don't realize that we're, flirting with disaster. So
Makes perfect sense. In what specific way has GoBundance impacted your life?
It's been huge. Again, Tim originally bringing me in, and then working with David and Pat as well, and just so just I wouldn't be here without those guys. Guide me, help. I'll give one really specific example, and this comes from David Osborne. One of the limiting beliefs I always had for many years, and this is part of why I did it basically alone for so long, is I thought that growing bigger and scaling meant more work. And I'm like, I'm already working as much as I can or want to. So I don't, and what I finally figured out in talking with David is it's the other way around. Growing and scaling means less work because it gives you the ability to put the people and processes in place that you can step out of that day-to-day stuff and move to a higher level and do more. I mean, just look at how many horizontal income lines those 3 guys each have. They're not working more hours in a day than anybody else to do that. And that was something I learned. But for GoBundance as a whole, just just to be in an environment where there's so many other people who are successful in a variety of different ways, and that I can learn from and be inspired by and connect with. And it's just, at the last Champions event, I met, Bo Parfait, and Hope sorry if I'm not saying the last name right, but
I don't get that
anyway,
bad.
and and he's like, man, this. I'm like, damn, this is a guy after my own heart. He's just an investor. He is a mountaineer that has a level of 10 times where I am,
Yeah.
and just a genuine soul, a good guy. I mean, just if anyone has interacted with him, just talk about it, someone who comes across with a servant's attitude. And it's like, man, these are the kind of people that I want to spend time around. And GoBundance is full of people like that. So I mean, I could do an entire hour just of all the different ways that it's positively impacted and affected me.
Same. I'll ask you this next question about new member, but before I do, I just took real quick aside. You've been a member for a long time, obviously partnered with the elders, and I guess I am too, but that's not why I stay around. But do you think being a member for a year or two is just scratching the surface? I feel like that. Like people that are like, oh, I'll jump in for a year and see what happens. Like, you might want to think about like a 3-year mindset, before you really start to build the depth of relationship that really helps serve whatever it is you're trying to do. Do you agree with that or no?
Absolutely, 100%. It's a compounding effect. The longer you are, when you go to a winter event and you bump into the same guy for the 10th time, it's a different level than when you're meeting someone for the first time, or like, oh wait, I saw you on a call, right? I mean, and that's good, and that's the start of it.
Sure.
But it's a compounding effect, and I'd say the longer you're involved, the more consistently you show up, the better it gets for both you as the receiver and you as the contributor and giver.
Now, that might be your answer to this, but maybe there's something else you want to share. What advice would you give to a new or prospective member of a GoBundance community?
Actually, I like your answer, Jamie, of give it at least a 3-year mindset. The longer you're a part of it, the better it's going to be. And, find a way to consistently be involved. I think that might look different for different people. Like I know
Yeah.
some guys like just wholly dive into their local chapter and they're a big part of it. For me, I try to be on. I am involved in my local chapter, but not as much as a lot of other people are. But I try to be on every tribe-wide call that I can be. I think I've out of every single winter gathering we've had, I've only missed one.
Yeah.
So my focus is like the big, the tribe-wide calls, the tribe-wide events, because I feel like that's where I can connect with the most people. So just find a way where for you that involvement works, and stick with it for as long as possible, because the longer you do it, the better it's going to be.
I think that's great advice. Two quick things I always say is, one, you got to look at it like moving into a neighborhood. And every year you just pay your taxes, right? Because you get value from quality neighbors and great amenities in your neighborhood. And each year gets better than the next, right? By being in a specific neighborhood. But the other thing you just said as well about, I always say commit to a minimum consistent action. So it might be just you're in your pod. That's it. But that's 52 or 26 times a year, depending on how many times you meet, that you're interacting with other people that are invested in your future. And I think of Kobe, who always said, hey, everybody practices 2 times a day. I practice 3 times a day, which gives me 300 times more a year that I practice than them. And over 10 years, that's 3,000. And I just separate myself. That's how I look at consistently showing up, as opposed to just trying to do everything that GoBundance offers. So great advice on both parts. Let's do the GoBundance card game question to wrap it. Queen of Spades. Have you ever dealt with contention in your family regarding your entrepreneurial pursuits?
You know what? Thankfully, my wife, when we got married, she had the same mentality that I did, in that, like, hey, let's find something that we can do on our own. It took us years to find real estate. And if anything, it's not even really tension, but she is the one who got my butt moving. I didn't want to initially pay for some of the education and the courses that we took and the coaching that we paid for. And originally, if you had told me, hey, you're gonna pay these annual dues to be a member of a group, I'm like, I don't need to buy friends, get out of here, right? and it's just like that's not how it works. And so that was, I mean, again, and it wasn't like tension in a negative sense. It was her gently pulling me along, saying, "No, if we're going to successfully do this, this is what we have to commit. This is what we have to invest." And so I'm very fortunate. Her and I have had the same mindset. We've been business partners since day one. We work together, 7 days a week. We're home together all the time. And then in terms of my original, family of origin, my mom loves to remind me of this. She was our very, very first investor check ever. There hasn't been. No, I don't talk to our neighbors or anything like that about what we do. And again, that's another great thing about Gobundance is I can actually post like, yes, we just closed a $48 million deal, right? I can't tell my neighbors that. So yeah.
Yeah, I get that 100%. Behind every great man, as they say. So great answer. Andrew, I don't think you're a big social guy, so maybe it's a website, but where do you want to direct people for learning more about you and what you do?
Yeah, just our website. If you Google Vantage Point Acquisitions or just my name, it all comes up. But the website is vpacq.com, short for Vantage Point Acquisitions. And I realize, I can't be completely left behind, so I have to do something social. So I've settled on I can do LinkedIn, right?
LinkedIn.
So
I've
I
seen that,
actually
yeah.
do post and get on LinkedIn on a regular basis now. You're never going to see me doing dances on TikTok or Instagram or any of this stuff, but LinkedIn feels like, okay, that's more of a natural fit. So if you please, yeah, reach out, connect on LinkedIn. If you go to the website, there's a contact us form, and you can, fill that out and then set up a call. And hopefully, anyone who's listening, I'll see in Vermont or at another or in Lake Oconee or another event soon. So, all
I'll see you at both, my friend. Thanks for doing this. I appreciate it.
right, good talking to you, Jamie.